you run into sort of these ruts and you kind of get stuck in your ways as you age. But the good news is there are things that you can do to kind of guard against that.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. Hey, Darren, how's it going?
Pretty good, Walter.
So we're thinking about this idea about when you get on a really good trading streak and you have a whole nice run of winners, should you pull back? Is there like the inevitable drawdown coming? Have you really pushed your luck? This idea comes up quite a bit, and I'd love to hear sort of your thinking on the issue.
Yeah, I have a few ideas on this, and kind of coming from the other side, recently I've been talking with traders about whether you should take a break from trading when you're having a bad run. And one of the traders that I kind of work with, he found that in his testing, his best time to take a break was after a really good run. So he found that his worst weeks followed his best weeks, essentially. But I think that is down really to your particular approach to trading and your system. So for instance, if your system makes money when there's very high volatility and there's a lot of movement, then it's quite common after that for the market to take a bit of a breather and kind of take in that new price. So and I have recently just had a bit of a break after a losing period. And, for me, that has kind of been beneficial because although when I'm looking back at the charts now, I would have made money in that period where I've stopped trading, it's been kind of good as a sabbatical to just kind of recharge my batteries and step back and think, okay, I'm feeling all these things about my strategy now, and I'm feeling a little bit uncertain. And it was probably quite good that I did stop trading and I could kind of put it into some sort of perspective, really, in the bigger picture. 3 losing weeks is not unusual for my strategy, but when you're in it, it feels much more intense and important than it actually is. And there is this other idea of that you should trade your equity. I can't remember which trader came up with that idea. So, in effect, when your equity is going down, you should be reducing your position size, and when it's going up, you should be increasing it. So I think it's quite hard to nail down one rule on this idea, and I think really you kind of need to look at your style of trading and the sort of realistic expectations in the long run. And it might be that after a really good winning period, that it is good for you to take a break.
Yeah, it's tricky, isn't it? And I've heard some of those same sort of ideas about trading your equity curve, or if your equity curve goes under the moving average, then you stop trading live and you just trade demo until it gets above the moving average, or you reduce position size or whatever. And I've thought a lot about this, and I've looked at some different tests, and it's interesting because when you think about this, like exactly what you're talking about, which I think most of us listening, most of the traders listening to this have experienced this idea, this run of good trades of, I guess, for the lack of a better term, a lucky streak, right? Where you just happen to have, you might have a 65% win rate, but you just happen to have, a lot of winners in a row. You got 9 winners in a row or something like that. And then you're kind of looking over your shoulder, wondering if the losing streak's going to come right next. And vice versa. You could have the losing streak and then followed by the win streak. So it's interesting because if you look at it, if you've had an unlucky streak, let's say, and you've done poorly and you're in a drawdown, and then you cut back your position size, you're cutting back your position size just as you enter into that lucky streak again, it's going to take you longer to get out of that little valley that you've dug into, haven't you, with the drawdown? Now that's assuming, of course, that the little valley that you're in is just simply a normal drawdown and that your system isn't broken or you haven't totally, got to that point where you're not executing correctly. So I think there's a couple of things to untangle here. Like one, and I'd be interested to get your thoughts on this. One would be like exactly what you said, which is the system does well in different types of markets, and essentially the market's just changing now. So you've gone through a really good market, your system performed well, and now you're in a market that doesn't really match that system very well. So, for example, the classic would be your system does well when the market's trending, and when the market's directionless and consolidating and not really going anywhere, you kind of just break even or lose, or you're not making money if your system is is built around taking advantage of trends. So, my question is, how do you know that when you're in a lucky streak or when you're in an unlucky streak, it's due to your system characteristics versus if you're a discretionary trader, it might just be you. So, for example, our friend James, who's a very successful trader, he's noticed that his traders, I think he talked about it in that interview that we did. If you haven't gone back and listened to that 3-part series with James, it's really interesting because he's a fascinating trader, and he talks about how he only lets his traders trade for 3 months and then he cuts them off because he's learned that that's kind of about the max amount of time that they can do and trade and do well, and so they're automatically kicked out of the office and they're not allowed to trade anymore, which I find fascinating because it's kind of this idea that and he does the same thing. If he has a really good run and has a really good week, he might take off the whole next week or the whole next 3 weeks, and that's it for the month. So it's an interesting idea because it's the built-in assumption there is that you're going to revert back to the mean after a really strong streak of winners. And I'm just wondering if you're a discretionary trader, how do you know whether it's the market or whether it's you?
Well, this is a part of the problem of being discretionary, is that it's very hard to get an idea of how your system works in the big picture, because you're obviously, when you're back testing, you're having to presume what decisions you made at certain times, and it's where I kind of lean towards preferring systematic trading and just having a small amount of discretion. But I find with my testing is the distribution of the good and the bad periods don't have a nice clean pattern. For instance, this year on the pound yen, for 6 or 7 months my system just killed it. But at the same time in 2014 there was a 3-month period where it barely made any money, and I think it actually would have, over the whole 3 months, would have lost some money. And then there's periods where you have like a winning month and a month not so good, and a winning month and a losing month, and the distribution goes into more of a pattern, but it changes. And that's, I think, half of the problem with the systems we trade, is the distribution of the good and the bad periods are not a nice clean pattern. And obviously then when a bad period comes along, your first instinct is to presume that there is actually something wrong with your system, and the fact that it worked really well in your back testing and previous testing really was just a case of luck. And now your luck's run out, and this is why then people decide to change their system, which brings up more problems. So I think that how the good and the bad periods are distributed are the problems. If you knew you were going to get just sort of 1 week every month that was bad, then you could perhaps build some rules around it to avoid it. And I have this constant debate with other traders about finding ways of analysing the market to see if it's kind of set up right for trading, and whether it's a good idea to stop trading then, and whether we can kind of build a system to gauge it. And the answer from a lot of very talented traders is that it's really, really hard to do that. The one thing that we all notice is that when volatility drops particularly low, then it gets very difficult, not just for our system, but for many systems. And it's still very hard to have a black and white rule. Okay, the market's not going to be conducive this week, or okay, the market's set up now to make more profit. And a lot depends on the actual fundamentals that are going on around it. Recently with Brexit and the US election, the possibility of that not going the way everyone thought has caused that uncertainty. Volatility has dropped, and I think most people have been struggling. Whether you're supposed to stop then and wait till after, maybe that's a good idea. I've very rarely heard anyone say that they had a break from trading and it was a negative thing. So, thinking from the psychological side of things, sometimes having a break, whether you're winning or losing, could be a good idea.
Yeah, that's a great point. And I've found in my own trading that one of the best things that I can do is have what I like to call a fresh look at the charts. So what that means for me is I try not to really look at the charts that much during Asia. So I'll look when Asia, sort of when I wake up, because that's when the daily candles close for me. And then I'll go, okay, well, this is probably what I'm going to be looking at when the London market comes in, right? Which is basically I have my whole day open, and then that evening I'll have a look at the charts when London starts to start, when Europe starts to wake up. And so what's interesting is that I know that if I sit and watch the Asian chart unfold and watch the 4-hour candles or the 1 hour, whatever, I don't see the London Open as well. I don't know how to explain it. And the same thing happens when I go on a holiday. Like, if I don't see the charts for a whole week or something like that, and then I come back and go, wow, look at all this that happened when I was away and didn't really see the charts. And I might catch, like, on the news, it might say that the Aussie dollar's at, they'll say, they always quote the Aussie dollar, and it's always like an hour and a half old, like the quote on the news or whatever. But, I might see that or whatever, but I don't actually see a chart with all the candles and see where it's been going. I find that is a great thing for my trading, to see a chart fresh and have a bunch of candles that have printed that I haven't, I didn't actually see those print as it happens. I don't know why that is. But it's almost like I'm more open to what the market's done because I haven't been watching it do it. That's the best way for me to put my finger on it. I don't even know if that's true, but that's the reasoning that I've come up with, which is, if you're watching the market unfold, it's easy to kind of take hold of an idea and become a bull or a bear and just look for all that information that kind of fits your belief. Whereas if you step back and you don't really know what's going on, then you look at it, it's almost like you have to be more open to the information that the new information that you now have. Does that make sense?
Yeah, it does. And it's this storytelling gene that we have, isn't it? When we look at information with an uncertain outcome, we have no option but to make up a story in our brain. We're subconsciously doing it, and you're sort of building a bias as you watch the candles form, and then it's whether you like it or not, that bias is there, and it may conflict with how you may look at the charts if you came with your usual routine. And also I think when you sit and watch the candles form, you tire the brain out as well, and then you're much more likely just to fall back on a bias. And apparently if you're over 45, I think, or 55, the brain gets even lazier then, and it is more prone to falling back on biases. So I'm at a disadvantage to you there.
Well,
slightly.
You'd be surprised. Yeah, exactly. You'd be surprised how close I am to you. Yeah. So yeah, that's interesting because you bring up an interesting point. I've read a lot about this. In the last 2 years, I've read a lot about this. It kind of touched on what you just talked about your brain. And what's amazing to me is that, you're right. The data I've read is exactly what you say, is that you run into sort of these ruts and you kind of get stuck in your ways as you age. But the good news is there are things that you can do to help yourself. You know what I mean? To kind of guard against that. And so it's like even simple things like just, taking a different, like if you walk, let's say every day you walk to your coffee shop, or you walk to the, like me, if you were to walk to the ferry, or, drive, you drive a certain way when you leave your house and go to your grandkids, or to your, to go get some fuel or whatever it is, as long as if you can do simple things like vary that. Just varying that a little bit, and walking on the other side of the street and taking a different trip, different route instead of taking the same route that you always do. You can teach yourself how to juggle. That can increase your information processing. So literally how fast your brain works just by doing something like learning how to juggle, because those things start to, we lose that edge in terms of the, It's not that we're losing intelligence. It's kind of the the engine is losing horsepower. I guess is the best way to put it. And so what's encouraging to me is that there are still things that we can do as we age to counteract that, which I think is pretty cool. And a lot of people don't think of that. They think in terms of, kind of resigned to the fact that, I'm 60 now, so it's all downhill from here or whatever. But I think it's pretty cool that you don't have to, you don't have to be resigned to that, I guess, is what I'm saying.
Yeah, and I'm sure experience balances it out, And the same piece of research I read also said that the most successful money managers were aged 40 to 45. So, so it's not just a young man's game. There's experience plays its part greatly as well.
Yeah, absolutely. So what do you think that those experienced money managers would do after they have a really good run? Keeping with our topic. So what if I were to put myself in the shoes, I'm saying, okay, I'm running, I'm one of the top funds, and, we've got this excellent track record running back 25 years, blah, blah, blah. And we've had this really good run. This month we've had a really good run. We're only 8 days into the month. We've had a really good run this month. So my choices are, we keep trading as normal, or maybe, same position size and everything, take all the signals, or we might reduce our position size and try and bank what we've already won, this month, or do we just pull out and say, okay, that was a nice month. We'll see you on the golf course and come back in 3 weeks or whatever. What do you think? What do you think the fund manager, the 43-year-old fund manager, is going to do here?
Well,
it's tough.
I don't really have the answer, but there was this Michael Mauboussin also looked into this, and he looked into traders that got dropped and traders that got employed, and how they their performance after they'd been fired or hired changed, and they found that most money managers would cut traders who had been underperforming, and out of those traders that underperformed, they then went on to perform better than the traders with the good performance that they were replaced with. So essentially what that's saying is that you are going to have ups and downs, and the preceding results are not related to those results you had before. So if you are going to take a break after having a winning period, then it should be for more of a systematic reason than the fact that you're guaranteed now to have a bad losing period. And I know there will be exceptions to that in certain styles of trading may well benefit from it. But the big picture is that just because you've had a winning streak, it doesn't necessarily correlate that you're now going to have a losing streak or vice versa. Yeah,
right. Yeah, that makes sense. And, I think you could, if you really wanted to get, if you were so inclined, if you really wanted to get sort of, quantitative about it, you could plot it out, and you could say, okay, here's, my win rate's 53%, and with this win rate, I would be expected to have over the next 10,000 trades, the likelihood of 10 losers in a row is pretty high, or whatever that number is that you think you're going to, and so you kind of plot it that way, and you can go, well, assuming that these statistics apply, and we can get into that whole argument because they may not, right? They may not, okay? But let's just assume that they do in this case. So we can say, look, I'm at the 2+ standard deviations away from my expected losing streak. My expected losing streak is to be, around, 5 or 6 losing trades in a row, and now I'm on my 17th losing trade. So I'm well outside of, the norm here. So what's going on? Is it, the question is it me? Is the system completely broken, like it just doesn't work anymore? Am I not executing the system? Is it me, or is it the system is just done? Or is this just a really, really unlucky streak? Because if we can push it out beyond 2 standard deviations, boy, that's really unlucky. That's like extremely unlucky to be at that stage. So that could be a way to do it too, is you could approach it from there, and you go, like, you say like Darren. Darren says, look, I know my win rate's 52%, and I've been running a 58% win rate over the last 2 months. It's probably going to come back. Or you could, like I said, you could approach the other way. You go, well, I know that my average losing streak is going to be 6 losing trades in a row plus or minus 3, So, from 3 to 9 losing trades in a row is pretty normal. And once you push it out, 6 losing trades, you push it out and double that to 12, that could happen occasionally, but once you get to like 15, 16, 17 losing trades in a row, that might be something that's a rare event. You might see that once every 10,000 trades or something, or you know what I mean? Like once in 10,000 trades or something like that. So yeah, that would be another way that you could do it. And so it's kind of like, when you're in the hospital and they're taking these vital signs, they're just making sure that your blood pressure isn't completely plummeting or whatever. You could kind of do that too with your trading, and that'd be a way to plot it. And so you could see that, okay, well, I'm within the range here or whatever. And the best way to get that is probably to run Monte Carlo studies. So you plug in all your data, all your information on your system, and you just run it over and over again. You say, okay, this is about what we're going to expect. I mean, that's about as close to you. I think, to me, that's about as close as you can get to kind of nailing it down so that you know what to expect. And but it always could be you. It might be you. It might be that you're not executing the system. Maybe you've got a lot of discretionary levers to pull in your trading, and that could be what's going on. But yeah, I guess that would be the only thing that I could really offer to people listening to this, is maybe that's the way to do it. If you're quantitatively inclined, you might kind of just keep vital signs on your system and see if you're well beyond what would be considered a normal drawdown.
Yeah, and I think keeping good records on your trading, full stop, is can never be a bad thing.
Yeah, because you'll catch yourself, won't you, Darren? Like if you start doubling down, I've had these losers, and some you catch yourself upping the risk or something crazy like that. You'll see those things. Those things will start to crop up, and just writing it down can also help you deal with it too. Like just having right. I mean, that's what you do a lot of.
Yeah, and it's
in your you find that, right? It purges it. Yeah,
it's always about keeping those short-term expectations in touch with the long-term expectations, and things in the short term can seem really extreme and drastic, but when compared to long-term data, then you can really put things into perspective, and then you can make much better decisions. Which is what trading is about, essentially, at the end of the day. It's making as many good decisions as you can.
Exactly. Cool, Darren. Well, this has been great, and I really appreciate your time. And I'm looking forward to talking about the average Joe and whether the market is stacked against the average Joe next time.
Okay, Walter. Thank you, mate.
See ya.